Question 1. Which of the following is not a typical characteristic of a non-proportional reinsurance agreement? A. The reinsurer assumes a fixed percentage of all losses above a certain threshold. B. The reinsurer is responsible for losses above a specific retention limit. C. The ceding insurer shares a fixed percentage of all losses with the reinsurer. D. The reinsurer's liability is determined by the amount of losses exceeding an agreed threshold. Answer C. Explanation. Non-proportional reinsurance, such as excessive loss or stop-loss reinsurance, involves the reinsurer taking on losses exceeding a predetermined amount. The reinsurer's liability is generally linked to losses above the retention limit, not by sharing fixed percentage of all losses, which is typical of proportional reinsurance. In proportional reinsurance, like quota share, the ceding insurer and reinsurer share based on fixed percentage, but this is not the case in non-proportional reinsurance. Question 2. Scenario-based. Mr. Harper is the chief risk officer of an insurance company based in Missouri. His company recently purchased a stop-loss reinsurance policy to manage catastrophic losses from a major flooding event. However, the company has incurred significant losses in multiple smaller flood incidents which fall below the stop-loss threshold. What should Mr. Harper do next regarding the company's reinsurance strategy? A. Focus on increasing the retention limit under the current stop-loss policy to cover more claims. B. Review the terms of the stop-loss reinsurance to ensure claims below the threshold are handled properly. C. Switch to a quota share reinsurance arrangement to share the smaller losses more effectively with the reinsurer. D. Discontinue the stop-loss policy and seek facultative reinsurance for each flood event separately. Answer B. Explanation. In this scenario, the stop-loss reinsurance policy is designed to cover catastrophic losses, not smaller losses. Mr. Harper should review the terms of the stop-loss reinsurance to confirm whether any smaller claims fall outside the threshold, ensuring that such incidents are being managed according to the policy's provisions. The stop-loss policy won't cover these smaller losses, but it's important to confirm if there is any provision handling them through another arrangement or ensure proper documentation for future claims. Question 3. Which of the following is a key consideration when determining the pricing of reinsurance treaties? A. The reinsurance premium is solely based on the reinsurer's past claims experience. B. The pricing is adjusted by the historical performance of the ceding insurer's risk portfolio. C. The reinsurance premium depends only on the risk profile of the reinsurer's overall portfolio. D. The pricing considers both the loss history of the ceding insurer and broader market conditions. Answer D. Explanation. When pricing reinsurance treaties, the reinsurer takes into account various factors, including the historical loss experience of the ceding insurer and the broader market conditions. Market trends, underwriting cycles, and the ceding insurer's claims history all play a role in determining the pricing of the treaty. The premium isn't based solely on the reinsurer's past claims or solely on the risk profile of the reinsurer. Portfolio is balance of multiple elements. Question 4. Which of the following statements about facultative reinsurance is correct? A. Facultative reinsurance is a mandatory arrangement for all types of insurance policies. B. Facultative reinsurance covers a specific individual risk or a defined group of risks. C. Facultative reinsurance automatically applies to every policy issued by the ceding insurer. D. Facultative reinsurance allows for automatic coverage of a portfolio of risks without individual assessments. Answer B. Explanation. Facultative reinsurance is a type of reinsurance where a ceding insurer negotiates and arranges coverage for individual risks on a case-by-case basis. This means that each risk or group of risks is evaluated and covered separately as opposed to automatic coverage under a treaty. Option is incorrect because facultative reinsurance is not mandatory for all policies, and options C and D describe automatic or treaty-style arrangements, which are not characteristics of facultative reinsurance. Question 5. Which of the following is a key regulatory requirement for reinsurers operating in Missouri? A. Reinsurers must demonstrate the ability to pay claims, but not meet any solvency or capital adequacy requirements. B. Reinsurers must maintain sufficient reserves and capital to meet financial solvency standards. C. Reinsurers are exempt from reporting financial statements to the Missouri Department of Insurance. D. Reinsurers must submit claims data only for catastrophic losses, excluding smaller claims. Answer B. Explanation. In Missouri, Reinsurers must comply with solvency and capital adequacy requirements, which are enforced to ensure they have sufficient financial resources to pay claims. The Missouri Department of Insurance monitors these standards to ensure that reinsurers maintain the proper reserves and financial stability. Option is incorrect because solvency and capital adequacy requirements are crucial for reinsurers. Option C is incorrect as reinsurers must report financial statements to the Department of Insurance. Option D is also incorrect because reinsurers are required to report all relevant claims data, not just catastrophic losses. Question 6. Which of the following best describes the concept of retrocession in reinsurance? A. Retrocession refers to the reinsurance of a reinsurance policy by another insurer. B. Retrocession involves a reinsurer sharing a portion of the original ceding insurer's risk. C. Retrocession is a type of facultative reinsurance. D. Retrocession refers to a situation where the reinsurer assumes all the risk of the ceding insurer. Answer A. Explanation. Retrocession refers to the practice where a reinsurer transfers some or all of the risk it has assumed to another reinsurer. It is essentially reinsurance of a reinsurance policy. This is common in cases where the original reinsurer needs to offload risk for capital or risk management reasons. Option B is incorrect because retrocession does not involve the original ceding insurer directly. It involves the reinsurer transferring risk to another reinsurer. Option C is incorrect as retrocession is not a form of facultative reinsurance, which involves risk transferred directly between the ceding insurer and reinsurer. Option D is also incorrect as retrocession involves the transfer of risk, not the assumption of all risk by the reinsurer. Question 7. In Missouri, which of the following is a primary factor that affects the solvency requirements for reinsurers? A. The number of policies issued by the reinsurer. B. The historical loss experience of the ceding insurer. C. The total amount of reinsurance premiums collected by the reinsurer. D. The reinsurer's financial strength and ability to meet obligations. Answer D. Explanation. In Missouri and generally across the insurance industry, solvency requirements for reinsurers are primarily based on the reinsurer's financial strength and its ability to meet obligations. These include the reinsurer's capital reserves and overall financial health. The state monitors these factors to ensure the reinsurer can cover claims and remain financially stable, while premiums and policies issued. Options and C. Important, they are not the primary factors used in determining solvency. Option B is incorrect because the historical loss experience of the ceding insurer impacts pricing but not directly solvency requirements. Question 8. Which of the following is a key difference between quota share reinsurance and surplus share reinsurance? A. Quota share reinsurance involves the reinsurer assuming a fixed percentage of the ceding insurer's losses, while surplus share reinsurance involves coverage for losses exceeding certain amount. B. Quota share reinsurance applies to larger risks, while surplus share reinsurance is used for smaller risks. C. Quota share reinsurance does not involve any shared risk between the ceding insurer and the reinsurer. D. Quota share reinsurance involves multiple reinsurers, while surplus share reinsurance involves single reinsurer. Answer A. Explanation. The primary difference between quota share and surplus share reinsurance is the way in which the reinsurer assumes losses. In quota share reinsurance, the reinsurer assumes a fixed percentage of the ceding insurer's losses, regardless of the loss size. In surplus share reinsurance, the reinsurer only covers losses exceeding certain threshold of the surplus. Option B is incorrect because both types can apply to a wide range of risk sizes. Option C is incorrect because both types involve shared risk between the ceding insurer and the reinsurer. Option D is also incorrect as both types may involve either one or multiple reinsurers. Question 9. Which of the following is a key consideration when determining reinsurance pricing using the loss cost method? A. The reinsurer's current solvency ratio. B. The projected future claims cost of the ceding insurer's portfolio. C. The economic conditions of the ceding insurer's country of operation. D. The reinsurer's market share in the global reinsurance industry. Answer B. Explanation. The loss cost method of reinsurance pricing primarily considers the projected future claims cost of the ceding insurer's portfolio. This method uses historical loss data and expected future trends to determine an appropriate price for the reinsurance coverage. Option is incorrect because the solvency ratio of the reinsurer is not directly related to the loss cost method, although it may affect other aspects of reinsurance pricing. Option C is incorrect because while economic conditions are a factor in pricing, they are not the primary consideration in the loss cost method. Option D is incorrect because the reinsurer's market share does not directly affect the loss cost method. Question 10. Which of the following best describes the purpose of claims allocation in proportional reinsurance? A. Claims allocation refers to how the reinsurer determines which claims fall under a specific treaty. B. Claims allocation involves splitting the financial responsibility for each claim between the ceding insurer and the reinsurer based on a predefined percentage. C. Claims allocation is used to determine which reinsurer will handle a specific claim in a multi-reinsurer arrangement. D. Claims allocation involves the ceding insurer covering all claims up to a certain limit and the reinsurer covering the remainder. Answer. B. Explanation. In proportional reinsurance, claims allocation refers to how the financial responsibility for each claim is shared between the ceding insurer and the reinsurer based on a predefined percentage. In a quota share arrangement, for example, if the ceding insurer retains 30% of a claim, the reinsurer would cover the remaining 70%. Option is incorrect because claims allocation is more about the financial division of claims, not identifying which treaty covers which claims. Option C is incorrect because the allocation is based on predefined percentages and does not involve selecting reinsurers in a multi-reinsurer arrangement. Option D is incorrect because this describes the retention limits typical of non-proportional reinsurance. Question 11. Which of the following is a characteristic of treaty reinsurance? A. Treaty reinsurance is negotiated on a case-by-case basis. B. Treaty reinsurance applies automatically to a portfolio of risks. C. Treaty reinsurance allows for a high level of flexibility in selecting individual risks. D. Treaty reinsurance involves the reinsurer covering only the risks it specifically selects. Answer. B. Explanation. Treaty reinsurance involves an automatic transfer of a specified portion of the ceding insurer's risk, typically covering a broad portfolio of risks. It is not negotiated on case-by-case basis, unlike facultative reinsurance. Option is incorrect because treaty reinsurance is not case-by-case. Option C is incorrect because treaty reinsurance does not allow for flexibility in risk selection. It covers defined risks as per the treaty. Option D is incorrect because that describes facultative reinsurance, not treaty reinsurance. Question 12. In Missouri, reinsurers must meet which of the following solvency requirements? A. Reinsurers must maintain a solvency margin that is at least 100% of the prescribed amount. B. Reinsurers are not required to meet solvency margin requirements as long as they are licensed in another state. C. Reinsurers are exempt from solvency requirements if they have no outstanding claims. D. Reinsurers must maintain a solvency margin that is 50% of the prescribed amount. Answer. An explanation. Reinsurers operating in Missouri are required to maintain a solvency margin that ensures they have enough financial resources to meet their obligations. This margin must be at least 100% of the prescribed amount to demonstrate financial stability. Option B is incorrect because solvency requirements are state-specific and apply regardless of licensing in other states. Option C is incorrect because solvency requirements are based on overall financial health, not the status of claims. Option D is incorrect as it underestimates the required solvency margin. Question 13. Which of the following types of reinsurance involves the reinsurer covering losses that exceed a specific dollar amount, often referred to as an attachment point? A. Quota share reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer. C. Explanation. Excessive loss reinsurance is a form of non-proportional reinsurance in which the reinsurer covers losses that exceed a certain threshold or attachment point. This threshold represents the amount of loss the ceding insurer must absorb before the reinsurer becomes liable. Option is incorrect because quota share reinsurance involves the proportional sharing of losses. Option B is incorrect because surplus share reinsurance involves sharing a portion of the losses above a certain retention level but not based on an attachment point. Option D is incorrect because facultative reinsurance is negotiated on a case-by-case basis and does not typically involve an attachment point. Question 14. A ceding insurer enters into a treaty reinsurance agreement with a reinsurer for their entire portfolio. What is the most significant benefit of this arrangement for the ceding insurer? A. It allows the ceding insurer to take on more risk. B. It provides a guaranteed return on premium payments. C. It provides capital relief and reduces the need for reserves. D. It ensures that the reinsurer will pay for every claim made. Answer C. Explanation. A treaty reinsurance agreement typically provides capital relief and reduces the need for reserves for the ceding insurer as the reinsurer assumes a portion of the risk. This arrangement helps the ceding insurer manage its financial stability and solvency. Option A is incorrect because treaty reinsurance reduces the ceding insurer's risk exposure. Option B is incorrect because treaty reinsurance does not guarantee returns, but rather helps with risk sharing. Option D is incorrect because reinsurers do not pay for every claim. They share a portion of the losses depending on the terms of the agreement. Question 15. In the context of reinsurance, which of the following describes the role of the retrocessionaire? A. The retrocessionaire is the reinsurer that assumes risk from a ceding insurer. B. The retrocessionaire is the entity that reinsures the reinsurer. C. The retrocessionaire handles claims for the ceding insurer's portfolio. D. The retrocessionaire is broker who arranges reinsurance deals. Answer B. Explanation. A retrocessionaire is a reinsurer that assumes risk from another reinsurer, known as the retrocedent. This practice is referred to as retrocession. It allows reinsurers to manage and offload risk. Option A is incorrect because the retrocessionaire does not directly assume risk from the ceding insurer. It assumes risk from the reinsurer. Option C is incorrect because claims handling is typically the responsibility of the ceding insurer or the primary reinsurer. Option D is incorrect because a retrocessionaire is not a broker. Question 16. Which of the following methods is commonly used to calculate reinsurance premiums in a treaty agreement? A. Flat rate method. B. Loss cost method. C. Judgment rating method. D. Loss ratio method. Answer B. Explanation. The loss cost method is a common approach used to calculate reinsurance premiums in a treaty agreement. It is based on historical loss data and projected future claims costs, and it helps establish an appropriate premium for the reinsurance coverage. Option is incorrect because the flat rate method is typically used in certain types of non-reinsurance insurance arrangements, not reinsurance treaties. Option C is incorrect because judgment rating involves subjective decision-making by the insurer and is not commonly used for reinsurance. Option D is incorrect because the loss ratio method relates to pricing in primary insurance and is not typically used in reinsurance. Question 17. Mr. Harris is a ceding insurer that has purchased a facultative reinsurance agreement for a specific large commercial risk. The risk was assessed and a premium was agreed upon. What is the most important feature of this facultative reinsurance arrangement? A. The reinsurer covers all the losses for this specific risk without limit. B. The reinsurer covers a portion of the losses for this specific risk as per the agreement. C. The ceding insurer retains the entire risk but shares any excess losses with the reinsurer. D. The reinsurer automatically covers all new risks introduced by the ceding insurer. Answer B. Explanation. In facultative reinsurance, the reinsurer agrees to cover a portion of the losses for a specific risk as per the negotiated terms. It is a case-by-case agreement and the reinsurer is not obligated to cover all losses but only those agreed upon. Option is incorrect because facultative reinsurance typically involves the reinsurer covering a portion of the losses, not all losses. Option C is incorrect because facultative reinsurance does not involve the ceding insurer retaining the entire risk. Option D is incorrect because facultative reinsurance applies to individual risks and not automatically to all new risks. Question 18. Which of the following best describes a stop-loss reinsurance arrangement? A. A reinsurance structure where the reinsurer covers losses once the ceding insurer's losses exceed certain threshold and the reinsurer assumes liability beyond that threshold. B. Reinsurance structure where the reinsurer provides set amount of coverage for each claim regardless of the ceding insurer's losses. C. Reinsurance structure that guarantees the ceding insurer will not pay more than a certain amount for each loss. D. Structure where the reinsurer covers losses below certain attachment point. Answer A. Explanation. A stop-loss reinsurance arrangement involves the reinsurer assuming liability for losses once the ceding insurer's losses exceed specific threshold typically defined by stop-loss limit. The reinsurer continues to cover losses above that threshold. Option B is incorrect because stop-loss reinsurance is based on the threshold, not on set coverage for each claim. Option C is incorrect because stop-loss reinsurance does not limit the ceding insurer's loss payment per claim. It provides coverage beyond specific threshold. Option D is incorrect because this describes an excessive loss reinsurance arrangement. Question 19. What is a key characteristic of finite risk reinsurance? A. The reinsurer's liability is unlimited regardless of the risk retained by the ceding insurer. B. Finite risk reinsurance typically involves fixed term and limited amount of coverage. C. Finite risk reinsurance is used exclusively for catastrophic risks. D. Finite risk reinsurance has no impact on the ceding insurer's capital position. Answer. B. Explanation. Finite risk reinsurance is designed with a fixed term and limited coverage typically used to manage specific financial risks over time rather than for catastrophic events. It is not typically unlimited in scope. Option is incorrect because finite risk reinsurance is limited in coverage and duration. Option C is incorrect because finite risk reinsurance is not exclusive to catastrophic risks. Option D is incorrect because finite risk reinsurance can impact the ceding insurer's capital position, especially in terms of risk management and solvency. Question 20. Which of the following is a key advantage of using reinsurance for risk management? A. Reinsurance helps increase the primary insurer's exposure to risk. B. Reinsurance reduces the primary insurer's solvency margin. C. Reinsurance helps improve capital efficiency and stabilize financial performance. D. Reinsurance guarantees that the reinsurer will pay all claims. Answer. C. Explanation. Reinsurance is a critical tool in risk management that helps primary insurers improve capital efficiency and stabilize their financial performance. By transferring portions of their risk to reinsurers, ceding insurers can reduce the impact of large losses, ensuring a more stable claims ratio. Additionally, reinsurance allows insurers to underwrite more policies than their capital alone would permit, improving operate. Scalability. Option is incorrect because reinsurance is designed to decrease the insurer's exposure to risk, not increase it. Option B is incorrect because reinsurance improves the solvency margin by transferring risk, enhancing financial resilience. Option D is incorrect because reinsurance does not guarantee payment of all claims. Claim payments depend on the terms of the reinsurance agreement. Question 21. Which of the following is an example of a non-proportional reinsurance arrangement? A. Quota share reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer. C. Explanation. Excessive loss reinsurance is a non-proportional reinsurance arrangement where the reinsurer covers losses that exceed a certain amount, but the amount of coverage is not proportional to the premiums paid. Option A and B describe proportional arrangements where the reinsurer shares a percentage of both the premiums and losses. Option D describes facultative reinsurance, which involves a case-by-case agreement and can be either proportional or non-proportional. Question 22. What is the primary reason why a ceding insurer would purchase facultative reinsurance? A. To share a portion of its risk for a large individual exposure. B. To automatically transfer all risks to the reinsurer. C. To lower its own operational costs. D. To comply with state regulatory requirements. Answer A. Explanation. Facultative reinsurance is purchased for individual, specific exposures, typically larger risks that require specialized coverage. It is not automatic and is negotiated on a case-by-case basis. Option B is incorrect because facultative reinsurance does not automatically transfer all risks. It is specific to the risks agreed upon. Option C is incorrect because the purpose of facultative reinsurance is not to lower operational costs but to mitigate risk exposure. Option D is incorrect because facultative reinsurance is not typically required by regulators but is a tool for risk management. Question 23. In Missouri, which of the following is required for a reinsurer to be authorized to conduct business? A. The reinsurer must demonstrate a minimum surplus amount to be eligible for licensure. B. The reinsurer must only be rated by at least one credit rating agency. C. The reinsurer must be a subsidiary of the ceding insurer. D. The reinsurer must operate exclusively in Missouri. Answer A. Explanation. In Missouri, a reinsurer must demonstrate sufficient surplus as required by the state's insurance department to ensure it is financially capable of honoring claims. Option B is incorrect because being rated by credit agency alone is not sufficient for licensure. Option C is incorrect because reinsurers do not need to be subsidiary of the ceding insurer to be licensed. Option D is incorrect because reinsurers can operate across state lines as long as they meet the licensing and financial requirements. Question 24. Which of the following best defines the term retrocession in the context of reinsurance? A. The process of a primary insurer transferring risk to a reinsurer. B. The transfer of risk from one reinsurer to another reinsurer. C. The act of a reinsurer paying for a loss. D. The primary insurer's decision to retain risk. Answer. B. Explanation. Retrocession refers to the practice of a reinsurer transferring risk to another reinsurer called a retrocessionaire. This helps the original reinsurer manage its own risk exposure. Option is incorrect because this describes the ceding process, not retrocession. Option C is incorrect because retrocession is about transferring risk, not paying for a loss. Option D is incorrect because retaining risk refers to the primary insurer's decision, not retrocession. Question 25. Which of the following types of reinsurance is typically used for catastrophic risks? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Facultative reinsurance. Answer. B. Explanation. Excessive loss reinsurance is commonly used for catastrophic risks where large losses can occur suddenly and unpredictably. It provides coverage for losses above a specific threshold, which is ideal for managing high-severity risks. Option is incorrect because quota share reinsurance involves proportional sharing and is typically used for more routine risks. Option C is incorrect because surplus share reinsurance involves sharing risk above a specified retention amount but is not specifically designed for catastrophic risks. Option D is incorrect because facultative reinsurance is case-specific and not typically used for catastrophic risks. Question 26. What does the term cession refer to in reinsurance? A. The payment made by the reinsurer to the ceding insurer. B. The retention of risk by the primary insurer. C. The transfer of risk from the ceding insurer to the reinsurer. D. The reinsurer's agreement to pay for specific types of losses. Answer. C. Explanation. Cession refers to the transfer of risk from the ceding insurer to the reinsurer. The ceding insurer cedes part or all of its risk to the reinsurer to limit its own exposure. Option is incorrect because cession refers to transferring risk, not making payments. Option B is incorrect because retention refers to keeping the risk, not transferring it. Option D is incorrect because agreeing to pay for specific types of losses refers to the reinsurer's responsibilities, but not the cession process. Question 27. In Missouri, what is the maximum limit of liability for a reinsurer in a facultative reinsurance agreement? A. The limit is set by the ceding insurer based on the individual risk. B. The limit is prescribed by state insurance law. C. The limit is determined by the National Association of Insurance Commissioners (NAIC). D. The limit is unlimited and subject to the reinsurer's solvency. Answer A. Explanation. In facultative reinsurance, the limit of liability is set based on the individual risk being covered and the terms are negotiated on a case-by-case basis. Option B is incorrect because the maximum limit of liability is not directly prescribed by state law. It is negotiable. Option C is incorrect because the NAIC provides guidelines but does not set specific limits for facultative reinsurance agreements. Option D is incorrect because facultative reinsurance involves agreed-upon limits, not unlimited liability. Question 28. What is the primary purpose of quota share reinsurance? A. To transfer risk for a specific exposure on a case-by-case basis. B. To automatically transfer a fixed percentage of both premiums and losses to the reinsurer. C. To provide a reinsurance agreement for catastrophic risks. D. To allow the ceding insurer to retain all of its risks while sharing excess losses. Answer. B. Explanation. Quota share reinsurance is a proportional reinsurance agreement where the ceding insurer transfers a fixed percentage of both premiums and losses to the reinsurer. This helps the ceding insurer reduce its exposure to risk while maintaining a steady stream of income from the premiums. Option is incorrect because case-by-case agreements are covered under facultative reinsurance. Option C is incorrect because quota share reinsurance is not designed specifically for catastrophic risks. Option D is incorrect because quota share involves the transfer of a percentage of risk, not just sharing excess losses. Question 29. Which of the following describes the concept of retention in reinsurance? A. The portion of risk that is retained by the ceding insurer. B. The amount of coverage provided by the reinsurer. C. The amount of premium paid to the reinsurer. D. The process by which a reinsurer transfers risk to another reinsurer. Answer A. Explanation. Retention refers to the portion of risk that the ceding insurer retains after ceding a part of the risk to the reinsurer. This amount is typically specified in the reinsurance agreement and represents the level of exposure the ceding insurer is willing to maintain. Option B is incorrect because the coverage provided by the reinsurer is separate from retention. Option C is incorrect because retention is not about premium payments but about risk retention. Option D describes retrocession, not retention. Question 30. Which of the following is a major regulatory body overseeing reinsurance in Missouri? A. Missouri Department of Revenue. B. Missouri Department of Insurance, Financial Institutions and Professional Registration DIF. C. Federal Insurance Regulatory Authority, FIRA. D. National Insurance Regulatory Agency. Answer B. Explanation. The Missouri Department of Insurance, Financial Institutions and Professional Registration DIF is the primary regulatory body overseeing insurance and reinsurance activities within the state, ensuring compliance with state laws and regulations. Option A is incorrect because the Department of Revenue is responsible for tax matters, not insurance regulation. Option C is incorrect because FIRA is not a regulatory body in Missouri. Option D is incorrect because there is no National Insurance Regulatory Agency overseeing state-specific reinsurance matters.